I'm Nathan Smith. I'm an economic theorist who uses agent-based simulations to try to understand economic growth. And I want to present a few very interesting results today. Now, a little bit of background first. One of the big things that economists try to do, particularly development economists and economic historians, is try to understand what caused the Industrial Revolution and what caused what's called modern economic growth. Basically, for much of history, then people's living standards pretty much stayed the same from one generation to another, and then suddenly, starting about 200 years ago or so, there was really an explosion of wealth. And it happened in some places in particular, especially started in Britain, Western Europe, certainly the United States, and some places it still hasn't really reached today, although it's spread more and more over time. So economists are very interested in the question, why? So what I want to do is kind of test some theories, and I'll just show how this works first, before discussing a little bit further sort of what's going on behind the scenes in these simulations. But okay, so this first one, I'm conducting an experiment in which I'm comparing 4 economies, 1, 2, 3, 4, which are all exactly the same, except they have differences in the savings rate. Here, I'll go back and show the technology parameters. So we have 4 economies. You notice, watch this square, savings rate. So I go to economy 1, 5%, economy 2, 15%, economy 3, 25%, and economy 4, 40%. And other than that, everything is exactly the same. Same number of agents, same technology. This space represents the technology, so you can recognize it by appearance for now, before I explain a little bit more what this means. And so the 4 economies are exactly the same, except for the savings rate. So let's see what the impact of the savings rate on the development of this economy is. A little bit about the structure of this chart. You see the legend here: overhead, self-supply, market, retailing. This represents the capacity of the economy. It says labor, but it's actually sort of labor augmented by capital, so you could call it capacity use. And so what this chart shows is that everything that's under the green line, this is what society uses to cover its overhead. I'll pause this a little bit so I can explain while something interesting is happening. But everything between the green line and the red line represents the capacity that society uses, people just use to supply their own needs at home, self-supply. The area between the red line and the blue line represents the amount of capacity that is devoted to market production. So you're at the margin, you're producing things, not overhead, but you're actually being productive at the margin and producing things that you're going to sell to the market. And then it's hard even to see it, but the little gap between the blue line and the black line above that is what's devoted to the retail sector. So it's devoted to trading goods, buying and selling. And so those are the 4 things that are done with capacity in this economy. And so something very striking is happening here. We saw for a while the economies didn't really look that different. We had 5%, 15%, 25%, 40%. The 40% economy is now, there are big changes taking place. So it's basically just experienced the takeoff into sustained economic growth. And that's going to continue for a while. Let me show some other charts. This is the good space. It's the same thing you saw before, except now I've colored the dots to show what's happening with different goods. So black dots represent active industries. Red represents something that a retailer is trying to trade, but they haven't actually achieved any trades in the most recent turn, probably because they don't have any inventory. And then yellow is goods that are neither being produced nor being traded. And blue are goods that are being consumed, but that are not tradable. There are no retailers doing business in those. So those are things that are just being self-supplied. So you see down here there's a few blue Here there's a blue. But so it's these black points that really represent, this is where active industries are being established. So you see that this economy with the 40% savings rate, it's basically occupied this whole goods space. It's producing all the varieties of goods that are known. The one with the 5%, most of it is not available. I can show another chart here. This chart shows for the typical consumer how many goods are they making and how many goods are they using. So you see, usually people seem to specialize in making just one good. That will vary a little bit depending on the nature of the technology. But so how is it that they're able to consume more goods? You see, they're using a lot more goods. The red line is above the blue line. They're using a lot more goods than they consume. And this is realistic. This is what we do every day. People typically have one job. They do one very specialized thing, and then they buy all kinds of different goods. Well, we see that's what's happening in the simulation too. But you see, more goods are being consumed, particularly in this economy. This is the one that really stands out. I can't even tell whether there are more goods being consumed in this economy than up here. But this shows average utility, so again, the 40% economy, they've made a breakthrough, broken through into rapid economic growth. The others are all kind of stuck. Not much increase in utility. Utility is economists' term for happiness or pleasure, and it's a little bit artificial to measure it in a number. But there's a long philosophical discussion justifying how that can be done and what that means, what assumptions underlie it. In any case, to some extent, this is kind of an arbitrary function. So what does it mean that these guys are 100 times happier? Well, it doesn't really mean anything. But certainly they are getting to consume a lot more of a wide variety of goods. We can look at historical sales. So you see, these guys are not consuming more than 40 of anything, 50, 60, so a little bit more consumption here, way more consumption here. By the way, one thing about this to bear in mind about these utility charts, these guys are saving more, so they actually get less utility because they put some of that into the capital. So they are actually more productive. Economy 2 and 3 are more productive, but they're putting it into savings, and they're not really coming out ahead much at this point. These guys are around 1. These guys are 1.25, maybe 1.5. Maybe they're getting coming out a little bit ahead. But obviously here there's a huge payoff. So we can look at utility by agents and retailers. Notice the retailers are doing a lot worse in terms of utility. I'll come back to that. That's kind of a funny feature of this simulation, which occurs a lot. You can see how they're using their labor, their productive capacity. These guys have a lot more of it. They're diversifying a lot more. You see, there aren't that many lines here. This is kind of similar. Here there's a lot more lines. A lot more goods being produced, which is also reflected, of course, in the goods space here. So you see this, almost the entire goods space has been occupied. The other economies have not broken through into that yet. And interesting question, how far is it going to go? You can leave it running for a bit while we go a little bit into the background. Now, I want to explain why this is a very important theoretical point. Nothing is different between these these four economies except the savings rate. And you look, this is an enormous expansion of productive capacity in this economy. And it's driven entirely by increasing capital. Right? Now economic theorists for a long time have thought this is impossible. They've thought that that modern economic growth cannot be explained by capital accumulation. This has been a fundamental teaching, and the reason that they thought this was because they assumed that the division of labor, the opportunities to increase productivity through the division of labor have been exhausted. This is a little bit strange that they assumed this, because Adam Smith, the founding father of economics, really stressed the importance of the division of labor, but But modern economists in about the past since the early 20th century have basically kind of pushed this to the side. They kind of pretended it wasn't there, or they talk about it, but they leave it out of their theories because they didn't have any way of modeling it. And that's why these simulations are so important, because I do have a way of modeling it. And so that goes into what's going on behind the scenes. Interestingly, now you're seeing a growth takeoff in the 25% economy, so it took them a little longer to get there, but it looks like they made it. And this is probably going to play out the same way. Now, again, if we go back to the goods space, I talked a little bit about the division of labor. Okay, here we have a very rich division of labor. People are engaged in about 30 different jobs or so. Here, only 5. So the division of labor is not exhausted in this economy, and that's why there's so much scope for economic growth. Okay, now let me pause this. Let me go to another example. Here we have an economy which again, there's 4 economies. Here's the goods space. It's a little bit different, but this is again explaining technology. In fact, let me take the opportunity now to explain what this means. L0, this is how hard goods are to make. Alpha, well-liked, that's how well-liked they are, and that also affects how useful they are in making capital. So those are correlated in this model. And each red point represents one good. And you notice that the way these points are distributed, the goods that are harder to make are also better liked. And that's partly why we saw that huge growth takeoff, is that once you get past, I mean, it was also the case in here. You've got the same general pattern. The goods that are harder to make are better liked. So as you increase capital, then you move into more desirable goods. Well, in this one, a little different. The economies differ by the population. Notice this number of agents. 20, 50, 100, 200. That's the only thing that's different about these 4 economies. Okay, so I'm going to run this, we can bring up this capacity measure again, and now we'll see how this one plays out. This is the one with the largest population. This is 200. 100, 50, and 20. You can look at what's going on in the goods space. See, there's a little bit more diversification here, and the tricky is really to jump over this gap. In fact, it might happen at any moment, so let's keep an eye on our capacity measure. Boom! Huge spike in economic growth. You see what's going on here. Suddenly they occupy the whole space. The way this is structured, it really lends itself to a big breakthrough when you get enough capital that you can start producing all those really valuable goods up in the upper right-hand corner of the goods space. So again, this is another explanation for breakthrough. Notice it's a different explanation. This is basically, you have a larger population in your economy, you can divide labor more intensively, and you can get a big breakthrough into economic growth, which is a lot harder to do if you have a smaller population. And this corresponds to some theories of modern economic growth, of development, corresponds to some theories of why the Industrial Revolution occurred. For example, how important is it to be open to international trade? Well, what does international trade do for you? The main thing it does for you is it gives you much bigger markets. It also allows you to specialize in your comparative advantage, but that's probably not the most important. The really dynamic effects are maybe that you get big economies of scale. At any rate, that would be the theory presented here. That you get a little bit larger population, you get this 200 population of 200. That's enough to trigger the growth explosion. Now these guys are probably going to get there too. They're accumulating capital. They'll probably eventually get there. Possibly even these guys will, but let's take a look at median and average utility. So you notice here, it's around 1, and you know, that looked like they were picking up a little bit, now they're coming back down. Here it's growing, and here you're really moving into kind of a takeoff zone. So economy 3, again we can look at it in terms of capacity. So there, yeah, you've got to take off there. Now notice these guys are really running out of capacity. So these guys, so eventually you do get to a steady state. Economic growth theory will sometimes talk about a steady state. So the economy grows for a while, but it eventually runs into diminishing returns. And then why does growth eventually stop? Well, capital depreciates and you have to keep replacing it. And capital is subject to diminishing returns if you keep investing more and more capital. That's the story in the Solo model, the sort of the most famous classical model of growth. That's what's going on here too, but it takes a long time to get there because there's really a lot that you can do with division of labor. You can look at the good space here. These guys have pretty much exhausted the potential for gains from division of labor. That's why they're running into diminishing returns. These guys are nowhere close. These guys are just producing the 4 goods, and these guys are only doing a little bit better. And I'm not sure whether they'll eventually get a breakthrough into modern economic growth or not. But so we have another theory that works. This is based on population and division of labor. And if we were going to try to explain the Industrial Revolution, we could say the British developed good road networks. They developed institutions that were better able to coordinate the efforts of a lot of people. Things like joint stock companies. They built canals. They were engaged in a lot of international trade. Western Europe was starting to become a more integrated market. For all these reasons, then the British were able to enjoy this big growth takeoff. So that would be theory contained here. And either one could work. It could be savings rates. Savings rates, this is a little bit more like the theory of Greg Clark. He's an economist who argues that over generations, the British basically, because the upper classes reproduce more, bourgeois values kind of filter down through the population. Bourgeois values including foresight, planning ahead for the future. So he tracks the fall of interest rates, and then so that's another theory. Now I'm going to give you a third theory. This theory is that new inventions make the difference. And new inventions are easy to incorporate into this model. There's a kind of a nifty way to do it. You just add something to the good space. So in this case we have 4 economies, and everything about these 4 economies is exactly the same, except economy 2, boom, new good appeared. Economy 3, another new good appeared. Economy 4, another new good appeared. So I put all the goods in the original technology here on the diagonal, just so that it's easy to see which of the technologies are the new ones, and that differentiate the economies from each other. So obviously economy 4 has an advantage. Everything else is exactly the same. Okay, let's run this one. So here again we can look at the measure of the economy's capacity. So far I endow agents with a little bit of capital at the beginning, and what tends to happen initially is they actually run down their capital stock because they haven't really learned to be very productive. So capital depreciates faster than they can replace it, and that's these 3 economies are still going downhill. They're still running down their capital. But over here with the 3 new technologies, here we see that these guys are managing, they're more productive, they're managing to kind of make a breakthrough in the economic growth. If we look at what's going on in the good space, see, these are all very desirable technologies. They're well liked, they're useful, they're not very difficult to make. So these are new inventions. I mean, if these guys in economy 1, if they knew about these goods, they would love to make them because they're really advantageous things to be making. But the idea here is that you get another invention, another invention, another invention. So this is invention as a theory of economic growth, what we have here. And so you see it's working now. If we compare utility, actually, utility is interesting here because you do have clear benefits in utility from these technologies. So utility rises from like around 8 to like these guys are up to about 20 and still rising a bit. These guys are up to about 75. But they don't really get a breakthrough. Basically, these technologies, they just kind of raise the economy to another steady state, which is a little bit higher, even significantly higher, but it's not, but it doesn't lead to ongoing economic growth. These guys, on the other hand, they're able to occupy almost the entire goods space. They're able to produce everything because what these technologies do is they allow them to accumulate capital faster, and then it allows them to produce all this stuff up here, which these guys actually knew about, but they weren't able to accumulate enough capital to actually make it. It wasn't economically viable. It was technologically known about, but it wasn't economically viable until these other goods were invented, and then you're able to make a breakthrough. And notice that this invention wasn't enough. It makes people a little better off, but it doesn't trigger ongoing economic growth. Same thing with these two. It's this third one that crosses the barrier and leads to a breakthrough into modern economic growth. Now, just in case people thought that you always get a breakthrough into modern economic growth, that's not the case, and I wanted to show just by way of contrast. This economy, notice that the technology here is set up for diminishing returns. You've got all these goods down here. These are really desirable goods. They're well liked. They're really easy to make. And those will be the ones that will be produced first, of course. And then eventually you can start to produce more as you get more capital, you get more capacity, you can start to cover the overhead costs of some of these, but these aren't really that well liked. And this actually would correspond to the theory, so this theory, this is kind of like, it's a version of Paul Romer's theory. Paul Romer is a well-known economist who, in his theories of economic growth, he really stresses invention, development of new ideas. So this is kind of a Romer type. And whereas this one is kind of like Tyler Cohen's theory of the Great Stagnation. This is the low-hanging fruit, and once you pick it all, meaning that you start producing these goods, you have to move into this high-hanging fruit, and you're not gonna get to enjoy as much economic growth. So let's show what goes on here. Look at capacity. Oh, by the way, I should give you a little bit more background here. What's the difference between these four economies now? 20 agents, 2% saving rate. 50 agents, 50% saving rate. Wow, I didn't realize I put it that high. But 100 agents, 10% saving rate, and 400 agents, 50% savings rate. So this economy one, I mean, we saw in the previous ones that it didn't necessarily take that big of a difference to make the switch. At 25% versus 40% savings rate made a huge difference. Now we make huge differences between these, but in spite of that, because of the nature of technology, the payoff is just not going to be as big to having more people and higher savings like this economy down here does. So we can look at what's happening to utility. So, I mean, actually, these guys actually have the highest utility right now, I think. Well, no, these guys, I guess these guys are a little bit ahead. But it's pretty similar. I mean, it's 10, 12.5, 7.5, and then around 10. It's all about the same. Now, if you look at the good space, you notice these guys are producing just a few of the goods, just a handful of them down there. And these guys are producing a few more. These guys are producing a few more. This economy, where you have the 400 agents and really high savings rates, they're producing almost all the goods that are available. In fact, if you look at, if we look at this is the diversification graph. So these guys are consuming about 5 goods each. These guys about 10. These guys about 10. These guys about over 20. So these guys are getting much more diversified consumption. But at the end of the day, it doesn't do you that much good when the technologies are up here. And if we go back to labor by overhead, okay, so these guys, their capacity is diminishing. They can't replace their capital, diminishing a little bit. These guys, it's rising a little bit. These guys, it's rising a little bit. So the high saving economies, they do see an increase in their productive capacity, but it doesn't really pay off that much because I've set up the technology in this case to feature diminishing returns. So you see utilities a little higher, 15 versus 10, but not that valuable. Okay. Now, I want to go behind the scenes a little bit and say what's happening in this economy. I mentioned earlier that that economic theorists have kind of ignored division of labor for a long time. The reason they've done this is because they don't really have any way to model markets, how markets work when division of labor is important. They like to assume that there's sort of an infinite number of people producing everything and consuming everything. They call this competitive markets, and so that's kind of their preferred way of theorizing. So let's go to economy 4 here. Well, I'll first focus a little bit on how agents behave. So these are agents. This is an agent who's not engaged in retail, who's just engaged in consumption. Yeah, maybe I should switch over to this economy and demonstrate it here better, maybe. Go to economy 2. So go to the agent detail. This is just an agent picked at random. So you see, so this agent, each round, he has a certain amount of labor that he can dispose of. Basically, it comes from his capital, and then he's got one. We can switch around. We can look at a lot of different agents. See how they behave. This guy's actually a good example. You see, he had 1.66 labor available. Now you notice for this particular good, he has to, L0 represents overhead. He's had to spend 0.59 or about 0.6 on overhead. The rest of that he devoted to production. He sold most of that. What he produced, so it's this minus that. He sold 0.9 of it. He earned 239, that's in money. Then he used the money to buy, for one thing to I don't know if he replenished it or ran it down, but in any case that's to hold on to his money. He had a little bit of reserves of money, and so between his earnings and his previous money holdings, he spent them on, he paid 0.64 for this good 10, paid 0.32 for good 16, paid 0.5 for good 19. So you see he's consuming several different goods, and he has kind of a wide range of choices. You see these check marks represent all the things that he knows how to make. So he knows how to make good 19, 15, 10, 8, and 5. And then these guys are all the retailers that he knows about. And you notice that he bought every product that he can. So he knows a producer of good 5. Well, in this case, he sold. So he sold to this guy. He knows some producers of good 10. He knows some producers of good 16. And he knows a producer of good 17 and a producer of good 19. So those are the retailers that he knows. So those are the people he can do business with. And if we keep running this, so this will keep changing up. It looks like see now he switched jobs. So we followed him through several turns. We could go to another agent. So this guy's he's also a specialist in producing good 5. This guy's a specialist in producing good 10. If you track this shows the good number, and then the red are the jobs that he's doing. The yellow are the goods he's consuming. So you notice he keeps consuming the same 4 goods. Those are what's available. And he's switched job. In a typical turn, he'll keep the same job. But sometimes he switches jobs. You can imagine various reasons why that might happen. If the wage rises for some job, he's basically solving a very complicated optimization problem every turn. That's why it's a little bit slow, because it's actually very complicated what the agents are doing. It's just the number of retailers that he knows about changes. And if we go to this developed economy, okay, totally different story. Lots and lots of goods to consume, and he doesn't actually even bother to specialize because he's got so much capacity that he home produces everything he can. But you notice he only knows how to home produce 5 goods. So we're now looking at a developed economy. This guy is consuming lots and lots of different goods. So he earns 66, 82, earns various amounts at whatever he specializes in. And notice I think he does typically produce only 1 good for sale. So in this case, he's specializing in good 6. He's only producing good 6 for sale. We go to this. So this guy actually produced 2 goods for sale. 1 good for sale. So people do usually only have 1 job, although some people are moonlighting and doing 2 different jobs. We got 1 job here. And these guys know a lot more retailers because there's a lot more retailers in the developed economy. Well, there's a lot more agents. I think that's the main difference here, right? It's only 50 agents versus 200 agents, so not surprisingly. So that's basically the agent behavior. They have certain skills. They have a lot of traders that they can do business with. They have to decide which of these overhead costs to incur. They have some motivation to specialize. Usually do 1 job, and then they take home their income, and then they become very diversified as consumers, and that gives them a lot of utility because the nature of their utility function is such that they like diversity. So if they can get it, they consume very diversely, but that's much less available if they're in a smaller economy where relatively few goods are being produced. So now we'll go to another screen and we'll take a look at how the retailers do business. And I really like this one. I think this is fun. 4 screens here. So this shows the whole history of a particular retailer. We're looking at retailer ID 48. Good 2 is the good that he's producing. And so this is, unfortunately, his sales prices dropped so much you actually can't see it. It would be kind of clustered against the bottom. This guy's pretty successful. This mode column, it's not very self-explanatory, but this is very important because number 1 means normal business conditions. It means he's not running out of supplies, he's not running out of stocks, and this guy's consistently in mode 1. So this is, some of these retailers get a, now back earlier when he was just getting started, he was often in the other modes. 3 I think is that's when he's running out of cash, and then 2, which he occasionally was just right at the beginning, that's when he's running out of inventory. So, but he eventually got into mode 1, and this guy's very stable. He's probably going to be around for a very long time. You see here, this is what income, supply, this is how much he's earning, this is how much he's selling. Now, this time that was 0. Didn't manage to hire anybody to produce goods for him. But now this shows the transactions. And if you look at these transactions, then you know it's always either he's earning and selling or he's buying. Agents are usually buying from him rather than selling. I mean, he has a lot more customers than he has employees. not surprisingly. And this screen, the short-term inventory dynamics, shows what's happening to his inventory in the course of any given turn. So here he's accumulating cash, he's running down his inventory, and that's actually been happening for a little while. That's a little bit troubling. You see, he hasn't been managing to get anybody to supply him, so that's okay. This time he did. So this guy's managing to do it, but a lot of times it's hard for retailers to keep their inventory stable. Let's try to switch it up. Okay, we got another stable one. This guy also seems to be pretty stable. He's similar. You notice the lines. But let's see if we can find somebody who's okay, this is an example of a more unstable one. You see his revenue, he was kind of stable for a while, but then his revenue is just started going crazy. He probably got a new competitor, and he's still staying in business, but so for a couple turns, you notice his transactions, he wasn't making any transactions at all, didn't manage to sell anything or to buy any goods. So if that continues, he's actually going to go out of business sooner or later. You see, this is the probability of his. If this becomes positive, he's going to start considering leaving this particular number. And so he must be competing with somebody. He's having trouble finding a price where he can actually sell goods. So you see here he's running into inventory problems. His inventory ran down. He ran out. So he has to, it's pretty tricky to be a retailer. You have to have inventory on hand all the time. You have to have cash on hand all the time. You have to kind of predict what the price is going to be. What they do is they basically try to clear the market. They judge based on their past experience how much cash do they think will come in and how much supply do they think will come in, and then they set the price as the ratio of those two, but then they add a little bit of a markup on each side so that they can turn a profit. And if we look at, this is kind of an interesting chart here. This shows agents. The red ones are retailers, the black ones are ordinary agents. Here we're seeing all four economies. So there's a lot more points here. This is the one with the large population than here. But you notice the retailers are much more spread out. The people who are doing the worst in the economy are almost always retailers. The people who are doing the best in the economy are almost always retailers. We can look at it from the point of view of a particular industry. In fact, let's look through a bunch of these. So industry 10 in this economy is basically a monopoly. Nobody's even trying to challenge this guy. His price is actually, interestingly, a little bit unstable in spite of that. But so we can look at industry 19. So this is a different one. This is kind of like a duopoly. You've got two retailers. They've both been in business for a while, competing with each other. And yeah, for now they're both in business. It's likely that at some point one of them is going to drive the other out, but for now they're both staying in business. So industry 18, here you see there's been a kind of a long-term predominant market player. This guy tried to challenge him. This line represents the price of a competitor, but he came in with too high a price and he couldn't compete, so he went out of business. And it's actually very difficult to challenge an established incumbent. Industry 5, so this is kind of a similar story. This guy stayed in business for a while. He eventually did manage to match his price, but this guy probably just had more inventory and possibly more market connections, although market connections aren't usually a problem. If you look down this list, so this shows how the population deals with this industry. Retailer 7 over here. Who knows about him? that's shown in this column, everybody knows about them. So advertising does play a role in here, but it's not very difficult. It's pretty easy to get for retailers to get their names out in this model. Industry 8, Industry 9, and this is, you can see a lot of different patterns here if you look around. I mean, we can actually do Economy 4 where you have more agents. See, this is kind of a fun one. You've got well, yeah, mostly you have one predominant incumbent. You actually have, right now you have a duopoly. You've got these two guys competing with each other. But a bunch more guys came in and tried to challenge them. Usually didn't last very long. Eventually dropped out. So yeah, that's kind of fun. This is even crazier. So Industry 7. I just picked that randomly, but you see 3 competitors right now. They've all been in business for a while, and then there's a bunch more challengers who came up. And so so if we go back to, if we think a little bit more about the big ramifications of this, and this capital dynamics are shown here in this table, and in this case I set the savings rate at 11. Capital conversion ratio is basically how much utility turns into capital. There's lots and lots of parameters. Most of them deal with the retail sector. Pause this so it doesn't keep renewing. Most of them deal with the retail sector. But what I've got here is I've got depreciation. So capital depreciates, but you also have savings. And it's the combination of these two that creates a really dynamic possibilities, because if your savings manage to outrun your depreciation a little bit, then you can really start growing a lot faster. And the thing is that a 1%, 2% increase in the growth rate over a long time, that has an enormous impact. Again, the goal here is to understand economic growth. Why is it that we saw this enormous takeoff in economic growth starting somewhere around 1800? And I mean, how far back before that it went, there's plenty of room for argument, but it really is a very striking change, a sudden, really drastic increase in living standards. It's even more impressive in a way in East Asia more recently, or in China. There's a lot of different theories about what might have caused that, and in a sense, I can afford to say they're all right. Did invention cause it? Yeah, invention could have caused it. Did an increase in savings rates and forethought, bourgeois values planning for the future cause it? Yeah, that could have caused it. Was it capital accumulation? Sure, it might have been that. Was it expansion of markets and increased division of labor? Sure, that could have done it. Institutions could have done it because they basically facilitate the division of labor. So in a sense, this can kind of confirm all the theories, but it throws in an element that has been left out in the past. And it's been left out because this way of looking at markets that I've just showed you, with all the retailers doing business, duopoly, and temporary monopolies that are perennially being challenged, and some goods that are just latent that maybe nobody's making because it's not economically viable to run a retail in that sector. This is a pretty new way of looking at markets, and it's really distinct from the sort of tradition of Walrasian equilibrium, the neoclassical tradition in which traditional growth models are based. From the perspective of traditional growth models, you can't have increasing returns. You can't have division of labor mattering. A lot of this stuff just gets excluded, and there was a lot of very invalid inferences that were drawn from the intuitive notion that capital has diminishing returns when people looked at that fact from the perspective of traditional theories of competitive markets. Now that I have a new theory, it unleashes all sorts of possibilities about what could cause this kind of dramatic dynamic change. And so So I hope this will basically be very useful to people who are trying to figure out what are the what's the nature of economic growth, what are the causes of the wealth of nations, and what kinds of theories might be able to explain that. Thank you very much.